Every bull market begins with one decision, a silent turn that most people don't even notice until it's too late. That decision is the pivot, the moment when central banks stop tightening and start easing again. It's not a headline, it's not an announcement. It's a quiet shift in the heartbeat of global liquidity. Right now, that heartbeat is weak. Rates are high, liquidity is scarce. And everyone keeps asking the same question. When does easy money return? Because that's what drives everything. Not news, not politics, not tweets. Liquidity is the oxygen of markets. Without it, even the strongest assets can suffocate. The Fed knows that. They've seen it before, and deep down, they know how this story always ends. Let's rewind. When the pandemic hit, the Fed printed more money in a few months than in an entire decade before that. Trillions flooded the system. It felt like free money. Stocks soared, crypto exploded, housing doubled. It was pure liquidity, a flood of easy dollars. But nothing stays free forever. That wave created inflation, the highest in 40 years. So the Fed had to fight back. They raised rates faster than ever in modern history, from 0 to over 5% in just a year. They drained liquidity through quantitative tightening. They wanted to prove they were serious, and it worked, for a while. Inflation started to fall, but the cost of that success is now showing up everywhere. Corporate debt is rising, credit cards are maxed out, small banks are bleeding deposits. Even the U.S. government is struggling to pay its own interest bill, now over $1 trillion a year. So the question isn't if they'll pivot, it's when they'll admit they have no choice. Here's the truth. The Fed doesn't cut rates because they want to. They cut because they have to. Every tightening cycle in history ends the same way. Something breaks. It might be a bank. It might be the bond market. It might even be the dollar itself. But something always cracks before policy changes. And when it does, the pivot begins, quietly, behind the scenes. You won't hear it in a press conference. You'll see it in liquidity flows, in the reverse repo chart dropping, in Treasury buybacks, in subtle phrases like financial conditions have tightened. That's code for we're scared. The market always knows before the Fed speaks. That's why bonds start rallying months before a cut. That's why tech stocks recover when rates are still high. Because smart money trades expectations, not headlines. So where are we right now? We're in the pressure zone, the part of the cycle where everyone still believes the Fed can hold the line. But under the surface, the foundation is shaking. Consumer debt is at record highs. Commercial real estate is collapsing quietly. Regional banks are merging to survive. And liquidity in the bond market, the deepest market on earth, is drying up. The Fed can't ignore that forever. They keep saying, we'll stay higher for longer. But markets don't believe them. They never do at this stage. In fact, the market is already pricing in cuts, not in 2027, but in 2025. That's how pivots happen. Investors force them. Because when liquidity dries up, something always gives. And when it gives, rates fall, whether the Fed likes it or not. Let's look at history for a second. In 2018, Powell said, "We're far from neutral." A few months later, the stock market dropped 20%. By 2019, he was cutting rates. In 2020, they said inflation would stay low. Then they printed $6 trillion, and in 2022, they said there would be no pivot. By 2023, they slowed QT quietly. It's the same dance every time. Talk tough, break something, reverse. The Fed's credibility isn't measured by what it says. It's measured by what liquidity does. But let's go deeper. Why does this matter so much? Because liquidity is not just about interest rates. It's about confidence. When people feel safe, they borrow, spend, and invest. When they're scared, they hoard cash. That's why every liquidity cycle is also a psychological one. And right now, the world is emotionally exhausted. After 3 years of inflation, wars, and uncertainty, everyone is tired of fear. That fatigue becomes fertile ground for optimism. That's how bull markets begin, not with excitement, but with relief. When people stop being afraid of losing, they start dreaming of winning again. And liquidity follows emotion. So what triggers the pivot this time? It could be recession data. It could be a banking scare. It could even be politics, the election year pressure to keep markets happy. Whatever the reason, the direction is already set. Because the system can't sustain high rates forever. The U.S. government itself is the biggest debtor, and every 1% in interest costs them hundreds of billions. That's not sustainable. Eventually, they'll choose liquidity over discipline, like they always do. It's not weakness, it's design. The modern financial system needs liquidity to survive. Without it, everything seizes up. Markets stop clearing. Confidence disappears. That's why tight money is always temporary. It's medicine, not a lifestyle. When the pivot comes, it won't look like an explosion. It'll look like relief. Yields dropping, stocks stabilizing, crypto waking up slowly, then suddenly. Because the same people who were scared to buy will rush back in, and they'll call it a recovery. But make no mistake, it's not recovery, it's reinflation, a new wave of liquidity entering the system under a new story. This time, that story might be technology, AI, blockchain, tokenization, new buzzwords to justify the same old cycle, more money chasing the next big thing. But the mechanism is the same. Liquidity fuels belief. Belief fuels price. Price fuels more belief. And the cycle resets. So when does easy money return? The answer, slowly, then all at once. The Fed won't announce it. They'll deny it until the last minute. But behind the scenes, liquidity will start sneaking back. You'll see it in swap lines reopening. You'll see it in yield curves steepening. You'll feel it in markets that suddenly stop falling. That's the first breath of the pivot. Quiet, invisible, but powerful. And when the Fed finally confirms it months later, the market will already be halfway through the rally. Because the pivot isn't a date. It's a shift in gravity. Think of it like this. When a plane climbs too steeply, it eventually stalls. Not because the engines fail, but because the angle becomes unsustainable. The only way to recover is to lower the nose and regain lift. That's the Fed right now, climbing too long, too steep, and running out of air. The pivot is their recovery maneuver. They'll pretend it's control, but it's survival. And the moment that maneuver begins, everything that's been suffocating, from stocks to crypto, will breathe again. That's how every major cycle begins. So yes, easy money will return. Not because the world deserves it, but because the system requires it. The Fed will call it stability. Politicians will call it growth. Markets will call it a new bull run. But underneath all the words, it's the same thing. Liquidity coming back home. And when it does, the calm we feel now will explode into motion. Money will flow again. Assets will fly again. And the same people who doubted it will say, "No one could have seen this coming." But you will have, because liquidity always leaves quietly and always returns louder than ever.